Now, let's practice the business combination process between the acquirer and acquiree. As you can see that we have a balance sheet of the parent company book value and the son company, the subsidiary company book value, as well as the fair value of the son company. And then this book value and the fair value has differences in asset. Usually the liability doesn't have differences. Okay, as you remember in class discussion, the fair value of net asset is the value for which the acquirer want to acquire this acquiree company. So how to get this fair value of net asset? Fair value of net asset is equal to fair value of asset minus fair value of a liability. So we use the fair value of asset and fair value of liability in a journal entry at merger cases. And then in acquisition cases, we use this fair value of equity is equal to the book value of equity plus the fair value of asset minus book value of asset, which is differences in asset. So it's the same concept because the consolidation financial statement can be presented as if a merger incurred. So let's go this practice. The book value of parent company and the book value of the son company, subsidiary company fair value. The book value of net asset is total assets minus total liability. The same way, the fair value of asset also the fair value of asset minus the fair value of liability, $118,000. So the difference between the book value, fair value, and the book value of net asset is $12,000, which is the same as this difference, $12,000 in inventory, 1,000, in PP&E, 8,000, in franchise intangible asset, 3,000. Okay, again, the company want to acquire this fair value of net asset, which is the same value as equity. Why? This net asset is as the fair value of net asset means the fair value of total asset minus fair value of liability. So the remaining is the equity. First case, 100% merger consideration case. Consideration amount is $130,000. As you remember, how to calculate the goodwill, we use this total consideration $130,000 and the fair value of net asset, even though the company has fair value of net asset $118,000. This parent company, the acquirer, is willing to pay more amount of money than this fair value of net asset by $12,000. This 130 minus $118,000. So let's go. How do we create the parent company's financial statements? In 100% merger cases, this asset company will be extinguished. So all the assets and liability are assumed by parent company, and the equity of this asset company will be extinguished. So how do you record? Right, we collect all the asset account, which is fair value, from this information. So we got this fair value. That is the fair value that are assumed by the acquirer company, the P company. Then how much is the payment? Right, the cash payment is $130,000. That is consideration. But the company also assumed, this liability as well. So liability, accounts payable, as well as fair value. The fair value of liability is usually the same as the book value, because the book value is considering present value of the liability. the bond payable also calculated every year based on the present value, which is the same as the market value, almost the same. So there's no the significant differences between book value and fair value in liability. So how do you get it? Here, goodwill. We can calculate simply 130,000 minus the fair value of net asset, or once we use this total, sum of this total asset, now minus sum of this total liability. That is the net asset, right? That is the net asset. But we want to get this cash amount minus, and then I want to just make parentheses. Oh, what's wrong? Oh, it's not minus. Okay, so we get the same result. Again, we get the same result. The total asset, fair value of total asset minus fair value of liability, which is net book value, the fair value of net asset, and then we paid $130,000 total consideration. So difference between the total consideration $130,000 and this fair value of net asset is also $12,000. Now let's put this journal entry into the what is this? Into the working sheet. This working sheet shows the how do we change the book value of this balance sheet of P company, considering this merger inclusions. So debit adjustment. We need debit adjustment for $47,000 in cash. And then PP&E, also we include the franchise. That is the inclusion. How about goodwill? Do you have goodwill? Yes, we have goodwill. Okay, so I believe we include all this asset account. The reason why I put this asset increase on the debit side, because asset is account of a debit that increase the asset account. And then on the credit side, cash, here we go, the cash out for the total consideration. Do you have any other asset account that should be recorded on the credit? No. Then let's put accounts payable, $2,000 assumed, and then bond payable assumed as well. So I believe we include everything. Now let's just make sure that we include everything. I just want to sum up, and then here is 0. I want to just sum up of this total, and we don't have any adjustment here on the total equity section. Why? Because we include all the asset and all the liability of subsidiary of S company. So this assets equity is automatically extinguished. Why? Again, what is the fair value of the net asset? Fair value of a net asset is the total asset minus liability, which is the fair value of the equity. So by including this all the asset and all the liability, then we actually, the P company actually merges the fair value of equity, which is the same. There you go. The fair value of net asset is equal to fair value of equity. So that's why there's no inclusion on the equity section. Okay. Now let's take a look at total equity on the credit side. There's nothing included. But here 16,000 increased. Now let's create the P's balance sheet, merge it. So the existing book value of cash plus debit adjustment increase minus on the credit So we got 148,000, which is new cash balance of this merged the financial statement. Then I include all this asset account is same calculation process. We increase this accounts receivable and inventory and PP&E and franchise. We increase everything. Then how about this accounts payable? Accounts payable liability starting from the existing balance $4,000 of a P company increased by $2,000. But as you can see, the minus debit adjustment, there's no debit account that decreased the accounts payable, but we have increased the value on the credit for the accounts payable. So the same way, I just want to increase like that way. Okay, and then we don't have any other increase in or decrease in total equity. So I got it. Then let's just sum up this total liability and equity. So do you see we have the same balance as the total asset and the total liability equity. So that is the merged financial statement balance sheet of P company when they merge this S company. Okay, then for the next exercise, we'll practice how do we record this 100% acquisition. This is not the merger case, but acquisition case with 100% consideration of $130,000, and then we'll compare between two. Okay, see you in the next video clip. Bye bye.